Good day, all. Ira Epstein with your SPDR ETF wrap-up for this Tuesday, CPI day. Yep, Tuesday, September 13th, 2022. Tomorrow we get the Producer Price Index. But if you saw anything on the CPI, you see how hot and sticky the inflation is. I think I have been one of the lone voices preaching over and over here that that's what I think is going to continue on for a bit. I think that when you exclude food and energy, you have sticky inflation. Well, you saw energy prices drop if you looked at the report. You saw food prices surprise. They were up. Didn't expect that. I think most people thought that would be down. Rents continuing strong. Lots of problems. So your headline number is what, 8.3%. The core inflation, though, climbed to 6.3%, and that's double the estimate that they thought. They thought they'd get 0.3 increase. They got 0.6 increase. And how's that going to sit with the Fed? Well, the Fed's got to be looking at this and say, hey, inflation is here. It is sticky. It's not just falling. Gasoline prices, we saw it fall, guys, for 3 months in a row. And basically, it doesn't matter. You're still there, and maybe it's even bottoming now. They've got to be aggressive. Do they want to scare the market is the question. So what I think happens is there's about now an 86 to 90% probability in that range. It's back and forth as the market, Fed fund futures are moving, of a 75 basis point hike. Some people are now saying, hey, maybe we should go with the 100. I don't know. I don't think that's the message the Fed wants. I think the Fed wants to be seen as the stable voice in a market that got away from them. They realized that this was caused by COVID and the helicopter money and everything. And President Biden trying to hide that his newest plan that he came out with is actually an anti-inflation plan. The name of it makes you want to laugh. So this report, they can't be very happy in the White House. I mean, this is all the bad news that they didn't need going right into the midterms. It's not going to sit well. Do I think we'll get a 100 basis point hike? No. Something else. You have to understand charts if you're going to trade these markets. There's two ways to make your investments. You can be an investor, which means you're looking at company values, whatever it might be. You can pick a spider. You can go with the individual company. You say, hey, I like this whole sector, and that's what I want to be invested in. Screw the chart. I like it. That's one way to go about it. The other way is a chartist. I'm a chartist most of the time. In Twitter, I had what's throwaway money. It's the only thing up on the board. I can't believe it. Oh, TLTs. Those are the two up. And I just do money at Twitter because I think the case for Musk is a terrible case that he has. I think once he signed that he wasn't going to do any more due diligence, it was game out the window. And I don't think that the snitch, whatever you want to call the gentleman that they brought in today in front of Congress, and he was saying all the bad things about Twitter. I listened to the conversation, but I didn't see anything other than management didn't do a very good job of listening to him. Does that mean the deal shouldn't go through? I don't think so. I heard nothing there about a lie that's fraud for this deal. Mismanagement might be there, but I didn't see that. And I think the market agreed with me. That's why it reversed up. Okay, but let's get back on this. This is very important. As a chartist, you're looking at chart patterns, doing what they are. You're always looking, is there something coming out? Could be an earnings report. Is there a key government report coming out that can hurt the chart pattern? The CPI was a big number report. I didn't make that up. The whole market has. This is the last big report before the FOMC meeting. The market believes, up until today, and they still believe that the Fed is going to blink. The Fed won't continue with with what they have to do because they're fearful they'll put the economy into a recession and crush everything. So you get these dramatic rallies that began in June. Then we had the break from Jackson Hole. Then you just had another big one. And today you get the CPI number that's a surprise, and you get the biggest single day break in the stock indices since 2020. You heard me, a 2-year break, biggest one. Why? Because people, they don't understand the importance of these reports. The report could have been friendly. Maybe inflation would have fallen. I gave you the scenarios, but that's my thoughts on that. So Shopify, of course, gapped lower, down 7% for the day. We'll leave this very shortly, but I just want to finish it up since I've been talking about it. It's caught in a trading range. You can visually see it. It's caught here from the 1907 to 3581. That difference is roughly $16. So $8 from that high puts you about 27, 28 that the market can go back to, and that's about halfway into the whole range. That's how I'm viewing it. Where's the 18-day average? Here's your first support zone. Isn't it amazing that it stopped there of all spots on the chart? Why didn't it just slice through it? Because traders look at that. Why did the market stop here on the blue line? Because traders like to look at key moving averages, and they were looking there at that average, and it's the 50-day average of closes, and they go, hey, that's an important number. I was watching a gentleman today on CNBC, a good chartist, by the way, and he tried to point out what the 200-day moving average was doing is how when it rolls down, if you get surprises, they're generally bearish. He's right. That's how you use moving averages. And what's he really saying? It's giving you the bias. Are you bullish or bearish? You're under it, you rally to it, your bias is down. Do you understand that? And today you got the surprise to the downside. Very smart, very good point that he brought up. So I look at this and I see that the market's caught right there. Market didn't make it up, did not to the Bollinger Band top or bottom. Okay, a trading range, and I'll stick with what I said. Last, you got overbought, you pulled back, and you're getting back into neutral. Once both numbers are under 70, which they are, you're no longer overbought. So the market's looking for a reason to make a trade. Let it develop one. AMC, all you did is rally back up to the 18-day average of closes and fail against the number. So this was what I call a bear market rally. You turn the swing line back up, it gets you to that resistance, and that's typically where you fail. When the market was going up here, you pulled back and you fought at the 18-day average, then you went up, you pulled back, checked it out, you're okay. I was surprised that you didn't do a little more work here. You don't have to stop. More times than not, you will. You can see that when you were down here, you got up there, you challenged it for a little bit, and then you came down. I can go over and over and prove that point. On Apple, it was so far a bear market rally, okay? But it's not a bear market. It's a rally in a market that was under the 18-day average, held very nicely the 100-day average, and I thought we would see resistance, and I said it here, go back, the tapes are still up there, you can see them, that you'd find resistance between the 200-day and the 18, and you have. Do I think there's a trend to trade here? No. Do I think people are nervous about this inflation? Yes. So even though pre-sales are very good, the market's caught with all the other nonsense. You know, maybe we'll look at Home Depot instead of Shopify in the next few days, because it'll get an interesting play with all this inflation, people not moving around in their homes and the like and so on. Mortgage rates going to go up. That could be a play. Okay, Disney, lower and low, higher high. You tell me what number this market went to and had the problem. Again, it's that 18-day average. Expect that. If you're up and you fall, you play there to make your decision. Well, that's what it did. I would have liked to have seen a few more days, but not getting it. So the market just playing its game right now. XLF, what we have here is a market void of trend. This got over for 2 days, the 18-day average. Never paid a lot of attention on the way back up. After it got under the 100, it checked it out and broke, but when it went through it, it just kept going through it. Don't know what to make on a chart like that. Nothing's ever always the same, but you get used to things that are the same, and you see them over and over, and they're like an old friend. So you got ahead of that 18, now you're checking it out, but were you in a trend? You were not. There's nothing to do with it. XLI, lower and low, higher high, a bear market rally to the 18, and now falling back into the general nature of the support of the 200-day average. I would expect tomorrow it's going to try to hold that average and hang in there. The question today is the panic of the day over and the market gets a little relief tomorrow? That's the big question that we'll see. It'll be in part on all these markets impacted by the PPI number. If that's not a crazy number, probably getting a little overdone today wouldn't be a surprise. In the semiconductor, a bear market rally and no more than that. The swing line was up. I said I thought you'd have trouble at the 100-day average in green. Market tried to find support there, right here. Breaks down, comes up, should have resistance into it, up to the 18-day average. Classic, what it should do. Is there a trade out of it? No. Still have the swing line up, the bias down. Home builders, this can't be good news for the home builders. Now you're going to get mortgage rates going up again. Expect over the next few days that you get a six-figure on mortgages. Yeah, that's going to be your next headline, and that'll be taken by the market as bearishness in the market again. Who can afford a home with 6% interest rates and all the variable rate mortgages that are going to keep resetting right now. So there's pressure coming to the marketplace. That too will pass. But this is the phase where we get up, where high rates have to happen to slow the economy down. And if you're not in that camp, shame on you. You're not listening to the Fed. They've got not only what they're saying, they've got now the data. Did they not say they'd be data dependent? They've got the data. Shame on them if they went 50 basis points at this meeting. I see zero chance of that. You'd have to have some world event happen between now and the meeting. I don't see that. Okay, XLE, all right. So now OPEC Plus, their monthly report says that the market is schizophrenic. I read the report. I attached it, I think, today in my morning paid subscriber full research. I write 2 reports a day for my people. And full craziness on our parts. Okay, so let me explain that. We're crazy because the market is not paying attention to OPEC. From their perspective, demand is X, and that means oil should be up. What they are not grabbing is market psychology. That's all. At the end of the day, psychology can win over fundamentals. It's not every time, but it can. I know that you've got most analysts thinking that we're still going back to the $100 Brent. Some thinking 125 is still there. Even the OPEC report today that came out modifies growth in the U.S. and China, but is not saying that we're going to crash in any manner. And they're smart. They do see something you should realize. This SPR, our strategic reserve oil, is going to stop coming out now. In fact, the Biden administration made some noise today about under $80 a barrel domestic, WTI grade. Maybe we should start buying that oil. Well, the first thing you have to do is stop letting it out of the reserve. You don't let it out of the reserve and replace it. You stop the reserve, then you start the replacement. You got to replace it. It's going to be replaced at a relatively high price. So I accept that, hey, there's going to be, if we're releasing 1 million barrels a day, how much oil are we going to buy at any point to replace it? Are we going to buy 1 million? The first thing that happens is that million is not going to be on the market in some manner. The second is there some portion of that we're buying every day